Hello folks, I'm here today to make the presentation of 790. This will be my last class in the financial risk management program, and I hope to graduate in a couple days. So I'm excited of that, first of all. And first of all, thank you for everything. I would like to thank the Kara for this great class, and I seriously learned a lot. And I like presentation of my work. Let's start with the project itself. Just our goal is to calculate the SCR standard approach. It's actually for Solvency II regulation, and we will just follow the formulas. We just calculate the numbers for the market risk of our insurance company's subsidiary portfolios, and then we switch to Moody's Analytics economic software generator, which is a great tool, and we imported our portfolio there, and we got the numbers, we run the simulation, and we compare our results, like what if we follow the Solvency II regulation, or what if we go with our internal model. It can be Moody's Analytics, it can be any other thing. I'm pretty sure the companies are investing heavily in the research and everything to build up a better model and to reduce their capital requirements. Okay, so I don't have assistant today, so I will do everything by myself. I hope I will be successful. Okay, let's start. My company is CNA Financial. Their headquarters in Chicago. The company was founded in 1967, and they are one of the biggest commercial insurance companies for writing premiums in property and casualty business. They have the 96% of their operations in property and casualty, and they write premiums mainly in California, New York State, and Florida. And they have some operations in life and group insurance, but it's quite low. So what I worked on is their subsidiary portfolios. Actually, they have 10 subsidiary companies, and but their all holdings are here. There's no foreign assets. Some of them are in Hartford, some of them are in New Jersey, some of them are in Chicago. And these subsidiary portfolios, for example, 46% of these portfolios consist of the corporate bonds, which is the biggest share, and 33% is municipals, and 9% is pass-throughs. The other, they have CMBCs, they have ABS, they have agency CMOs, but their proportion is not high. So the biggest three is corporate, pass-through, and municipals, both tax-exempt and taxable municipals. For example, equities. Equities are really low. It's lower than 1% in the subsidiary portfolios. Okay, yeah, we can start. This is the just brief introduction about the CNA Financial and their subsidiary holdings. As you see here, that I worked on the CCR formula approach there. I calculated the market risk or capital requirement for the market risk by applying the standard capital requirement formula, just the Solvency II regulations. Just it forces companies to either use this approach, the standard approach, or the companies are allowed to build their internal model, and unless it's validated by Solvency II. So in my project, I used Moody's analysis and analyze it, and I compare my findings with what if I followed the standard approach. So actually, let's start from the standard formula approach, the numbers. I have just the CNA subsidiary portfolios have exposure to the market risk. In terms of market risk, they have exposure to spread risk, interest rate risk, concentration risk, equity risk. They do not have any currency risk because they don't have operations, they don't have holdings in other countries, and they don't have property risk because they don't have property. The amounts, like the spread risk, for example, 75% of whole market risk is made up by the spread risk, so which is quite high number. The reason behind that is CNA subsidiaries, the bond, their fixed income assets, most is long tenors. Like 76% of the bonds are long tenors, and only 5% of the portfolio is short tenor. So I believe it makes the portfolio to have more spread risk exposure. And also another reason is around 10% of their investments is on non-investment grade bonds like Bs, CCs, Cs, BBs, and this also another trigger, I believe, to have that high number. Also, like corporate BB bonds, for example, which is the biggest share among the asset buckets. It is an investment grade, but it is not. I mean, it's like kind of in border. So all these things can create a pressure on the spread risk. And another one is interest rate risk. It is 16%, and we will come to that point later on. Just when I use the Moody's analytics simulations, I will talk about interest rate risk again in that section. And the concentration risk is 8%. Actually, if I had followed the standard approach formula and by plugging the numbers, the concentration risk is going to be 0. Why? Because CNA's portfolio is extremely well diversified. They do not have any exposure to an individual stocks or bonds. It is extremely well diversified portfolio. So instead, I decided to go with the buckets, like asset buckets, such as, let's say, for example, AAA, ABS, medium tenor bonds. So I created by myself. I made it up. And I calculated it as 8%. And the total amount is here. It's 8,713,000,000. The total capital required based on the standard formula approach, which equals to 26% of the portfolio's total market value. On the other hand, when I run the simulations of the total returns and 10,000 times and get the 50th smallest number of these 10,000 trials, the number is 5,283,000,000, which equals to approximately 16% of the portfolio's total market value. So there is the company, by applying the internal model, it saves 11%. So we know that the big companies, they have advantage over their peers by applying the internal model, but it requires a human resources, it requires a lot of research, it requires a lot of capital to build up an internal model. So that's why, for example, smaller firms, they have competitive disadvantage on this matter. For example, if they follows, as you see, most probably, maybe, I don't know, 99% of time, the internal model saves money. So, and CNA should do that. I'm pretty sure they're doing that. Let's talk about the distribution a little bit. Let's make the camera better. So as you see, the baseline until 0.5th percentile, which is actually our 99.5% var, the amount is 15.74. So until that point, the returns are negatively, the loss is around 15.79%. Now I would like to talk about the total return distribution. As you see on the distribution chart, it is almost perfectly symmetric. The distributions are just slightly skewed to the right, and there are no fat tails. Kurtosis is almost zero, and it's almost like it's perfect normal distribution. Let's see the numbers. Yes, it's the skewed right. It's negative 0.24, and kurtosis is almost nothing, 0.06. And this kurtosis is really important when we predict value at risk, because the almost zero kurtosis prevents us underestimating at high levels of significance. So if kurtosis was, let's say, 3 or beyond 3, and then calculating VAR might misleading us. So we don't have that problem here. And the annual average return of the portfolio is 4.4. This is arithmetic mean. Later on I use the geometric mean. I believe actually the geometric mean is more accurate when it comes to stock returns or the portfolio returns. And the standard deviation is calculated as 7.28% when we run the simulation at 10,000 times. The median is 4.8%, which is so close. As you see, the mean is 4.4 and the median is 4.8%, which is wonderful. The minimum range, another thing, is because we don't have fat tails here, the minimum return is 0.26 and the maximum is 28. They're close to each other. I mean, the degree is close and the range is reasonable. And another thing, if you look beyond the negative 22%, there's almost nothing here. Maybe just a couple observations. But on the other hand, on the positive side, which we would like to see more, beyond 20%, yes, we have some observations. It's like maybe around like 60, then goes up to 50s, 20s, 10s, and we still have around 10 observations out of 10,000 trials, and 24%, 25% annual returns. Now I would like to talk a little bit about risk-return performance. of the asset buckets. I included some like popular asset buckets here. You will see the corporates, which is the biggest share, and you will see the tax, both exempt and taxable municipals, which is the second biggest share in CNA's asset portfolio. I just added the Treasury, U.S. Treasury, and I just went with a couple ABS buckets as well. And you will see the average asset portfolio. Everything is included here. Average asset portfolio, risk return performance as well, and the downside is the equity. So first of all, our average asset portfolio risk return coefficient of variation is 1.72. Then it is like the geometric mean is 4.1%, and the volatility is 7%. I use the classical standard deviation approach for the volatility, and I added US Treasury because I believe there is nothing risk-free on the earth, so it has this quite low 1.1% annual volatility, and this is far best among the other assets. The coefficient variation is 0.45. I might have gone with the Sharpe ratio as well. The concept is same, so we just compare the returns relative to the risk we take, and I use the classical approach, the standard deviation for that. Equities are pretty bad. You see the risk is so high, 18.7% annual volatility it has, but the return is 4.8. So in my opinion, there is no need to take that huge risk, 18% risk, to have 4.8% return. For example, when you check the ABS BBB medium, you take the volatility is 5.3% and the geometric mean is 4.2. So you get similar return to the equity by taking almost like it's a lot lower. One is 18% and the other one is 5.3%. And let's see the corporate bonds. Like equity it's so low in the portfolio, so I don't need to talk a lot about it. But the corporates are important, corporate bonds. So corporate triple B long, for example, it's corporate triple Bs and corporate triple Cs are doing worse than the average of the asset portfolio risk return performance. But on the other hand, corporate AAA longs, it's doing better than the average. And the municipals, all municipals, either tax exempt or taxable, they are doing worse than the average asset portfolio performance. So I can say, I can conclude that the CNA for the portfolio optimization, CNA should increase the amount of the ABCs, both AAAs and triple Bs, because they are so low, their share is so low in the portfolio, but their risk return performance is good. On the other hand, the taxable municipals and tax exempt municipals, they have a big stake, but they are not doing well. Neither their returns are big, nor their risk, their volatility is low. And corporate AAA longs, for example, I can say here, just let me show you. Yes, corporate triple Bs accounts for approximately 30% of CNA's asset portfolio, while corporate triple As only sum to 1% of portfolio's total market value. So when we compare the risk return performance, corporate AAAs, I believe that the CNA asset management team should rebalance the allocation of the funds between corporate BBBs and corporate AAAs especially, and they should decrease the taxables, the municipals, and then they might invest instead in ABCs. I would like to talk about now the correlation matrix. I created a correlation matrix with 1 year spot rate, 5 year spot rate, 10 year spot rate, and I added inflation and equity returns, and as well as the portfolio return. So as expected, we have negative correlation with bonds and rates, and we don't have significant correlation with inflation and the portfolio returns, and also we don't have any significant correlation between equity returns and inflation. Portfolio, if you see the numbers, if you are able to see the numbers, portfolio returns, the correlation of portfolio returns. For example, they have negative 40.42% negative correlation with 1 year spot rate. However, when it comes to 10 year spot rate, the correlation jumps to negative 0.53%. So the coefficient is getting bigger and bigger as we moves towards longer maturities of the spot rates. I can say that. And another thing I can add here, that there is the equity return is negative 10 with 1 year spot rate, for example, but the portfolio return is almost triple, right? The coefficient is almost, the rate is almost triple. So we can say yes, portfolio returns are a lot more negatively correlated with interest rates than the equity returns. When we see, for example, when we check 10 year spot rate and equity return, it has negative 0.11, which is so close to the 1 year spot rate. So there is not much difference. But when it comes to portfolio returns, yes, as we move longer maturities, yes, it differs. I would like to talk about defaults now. In the Moody's Analytics software, I decided to add the defaults, upgrades, and downgrades of some asset bucket types. Like, because corporates have the biggest share, I added all corporates, mostly the CC, triple CCs, and BBs, triple BBs. I just added ABS and pass-throughs. They have 9% share. It's important, and I added ABS as well. And I also added the Moody's transition probability matrix, the industry average, to compare how the bonds, how the asset buckets are performing in CNA's portfolio. So both the ABS triple B medium and the corporate triple B medium have, of course, they have quite low chance to default. But when you compare with the Moody's average number, they are doing a lot better, which is great thing for CNA's asset portfolio. But the BBs, the triple BBs, or double A's, they have so low chance to default. So what mostly important is here the triple CCs. For example, CNBC, triple C, long tenor have 10% of default chance. Corporate, both long tenors, medium tenors, short tenors, they all have around 10% chance of default. And that number, these numbers like around 10%, they are lower than the Moody's average number, which I calculated as 16%. When I check online, I had different numbers. S&P saw around 22%, and it changes like every decade. So to be honest, I'm not pretty sure about the most logical number, logical years to compare, but the simulation gives me the 16%, the transition matrix, so I followed that. But the 10% itself, just I believe CNA asset, the bonds in CNA portfolio, they, at least I can say, they do not have high chance of default. The upgrades, the biggest market share in CNA's portfolio is the corporate triple Bs and AA pass-throughs, and this is the average number for BB, triple BBs, upgrades, and I ran that 10,000 times simulation, all numbers, even the Moody's and CNA portfolio, all numbers are based on the 10,000 trials. So as we see, like corporate triple B medium has 9% of chance upgrade in the next year, and Moody's have this number 6.3%. So yes, corporate BBs are doing better, and when it comes to pass-throughs, there is not much room for pass through AA medium to upgrade, but you see there is a big difference between the Moody's Analytics average. So these are good signs, healthy signs for CNA portfolios, and when it comes to downgrades, we see the same. Yes, Corp CNA portfolios are outperforming Moody's average, but the gap closes here is more close. Like the AA downgrade Moody's is 6.5%, and pass-through, for example, is 7.73. Yes, one of the most important thing is the stress testing of the portfolio, and what I can say is I decided to go with the 1-year government spot rate to stress the portfolio, and I calculated the total returns when we changed the interest rates 1%. I started with the negative 1% for the 1-year spot rate, and went through the positive 7%, and the total return when spot rate is negative 1%, it occurs the 12.7%, which is great. And then, of course, it decreases because of the negative correlation between the spot rates and the portfolio returns. And at 7%, I faced around negative 5% total return. And I calculated the change in returns to have a better understanding in convexity and the duration. So the duration is higher in the transition period from going to negative to positive. It's 3.6%. And the average duration, and I calculate it's 2.4%, which is quite reasonable number. And duration is not so volatile, especially when the interest rates reach to positive numbers, and which makes the portfolio have less risk exposure to interest rates. If you remember, in the standard standard approach calculation, I found the number is 16%. So that's one of the reasons. As you see, it's a proof like there's no fluctuation on the duration, which is really good for the CNA's portfolio. And what else I can say? Yes, this is the break-even point here. It occurs around 4.5%. So when the spot rate, 1 year spot rate, hits 4.5%, then the returns of the portfolio, CNA portfolio, turns into negative. So beyond that point, it turns into negative. Before, it's positive. So yes, I should say the convexity is steeper, then the interest rates are negative. And let's check the stress testing, the 10-year spot rate. Basically, it's not so different. Of course, we have negative correlation again, and I didn't include any negative numbers here because I don't believe it's realistic to have any negative interest rate prediction in 10 years. But I can say the duration is higher. So you see the change in total return. So when we increase the interest rates 1%, the total return actually shrinks. It comes from 14% to 11, and then 5, and then almost 0, and then big negative numbers are coming when we go beyond the 5% 10-year interest rates. Break-even point is again 4.5%. So beyond 4.5%, the portfolio's returns turn into negative. Basically, that's all I would like to talk about the variables and my analysis in CNA's portfolio. So, it's the last suggestions, the optimization. Let's talk about the portfolio optimization. We actually mentioned them, right? The internal model, first of all, creates, it decreases the capital required amount. It saves 11%, for example, in CNA's asset portfolio. So what CNA management team can do is they can invest more in human resources and research development to have even better internal model to save more and gain competitive advantage over their peers. And as we mentioned, they should think about investing in ABS bonds and decreasing the funds in the municipals, and they should rebalance the corporate triple Bs. The corporate triple Bs are doing well when it comes to default and upgrade and downgrade, but the corporate triple As have just 1%. So it should be balanced, I believe. And equities are low. They're not performing well, but their share is so low, so there's no need to talk about. Basically, that's it. Thank you for listening. And Kara, again, thank you for everything. Keep in touch.